So let's look at now the section C of our pre-June mock. On 1st January 2003, Persistent Pharma acquired 80% of the equity share capital of Smart Pharma Company. The share capital of Smart Pharma Company consisted of 7 million shares of $1 each. Persistent Pharma settled the consideration by issuing 2 new shares in exchange for every 5 shares it acquired. A further consideration was payable on 31st December X4 at 3 shares per acquired. On the date of acquisition, the fair value of each share, Persistent Pharma Company, was 6.50 and that of Smart Pharma Company was $4. Its cost of capital estimated to be 10% per annum. Statement of profit or loss for the year ended 30th September X3, Persistent Pharma and Smart Pharma. Revenue 45,000 and 27,000. Cost of sales 24,750, 18,900. Gross profit 22,50, 8,100. Sales and distribution cost 1.1 million and 1.3. Administration cost 2.6 and 1.6. Finance cost 300. Investment income 600. Profit before tax 16 million and 5 million. Income tax 2 million and 1 million. Profit for the year is 14 million and 4 million. The following information is relevant. On 1st January 2003, the fair value of the Smart Pharma assets was equal to their carrying amount with the exception of the following. An item of plant which had a fair value of 4 million in excess of its carrying amount. On that date, its remaining useful life was 4 years. Depreciation is to be charged to the cost of sales. These changes were not recorded by Smart Pharma in their books. There was contingent liability of $250,000 which had a fair value of $125,000 according to the evaluation done by Persistent Pharma Company. This had not changed on 30th September X3. It is a policy of Persistent Pharma Company to value the non-controlling interest at its fair value. On 1st October X2, the retained earnings of Smart Pharma Company stood at $12 million. During the post-acquisition period, Smart Pharma Company had sold goods to Persistent Pharma Company at the rate of $250,000 per month at the gross margin of 25%. Goods worth $300,000 were included in the inventory of Persistent Pharma Company on 30th September X3. On 1st October 2000 X2, Persistent Pharma had issued $3,000 5% convertible loan notes. The interest is payable in arrears over a 5 period. The interest rate of the equivalent non-convertible loans was 7%. Persistent Pharma had recorded the liability at par and recognized interest payment at 5% for the year. The discount factors to be used wherever relevant are discount factor in year 2 5%, 7% and 10%. Discount factor for year 5, annuity factor for year 2 and annuity factor for year 5. Goodwill was impaired by 25% by 30th September and is to be charged to administrative expenses. Profits accrue evenly throughout the year unless otherwise stated. Calculate the goodwill at the date of acquisition at 30th September 2000 X3 and that's 4 marks. Prepare the consolidated statement of profit or loss for the year ended 30th September X3. When valuing non-controlling interest at acquisition, IFRS 3 business combination, there are 2 methods permitted, the fair value method and the proportionate share of identifiable net assets. Discuss the initial calculation and subsequent treatment of goodwill on the acquisition would have differed had the non-controlling interest have been measured using the proportionate share of identifiable net assets at acquisition date. Show the calculation for the revised goodwill. So it's pretty much straightforward and simple questions, nothing much complicated. In fact, this question actually, if you get it in your examination, it's going to be really good because there are a lot of calculations involved and you will be able to do these calculations and you will be able to score more marks. Further, the third question is very simple. As you know, when you calculate when you calculate the NCI using proportionate share method, what happens? A proportion of goodwill of the subsidiary company will not go to NCI because it's based upon the net assets method. In net assets, whatever is the book value of the subsidiary, only that will be proportioned to the NCI. So because of that reason, NCI will not have or NCI may not consist a value of goodwill. And due to this, what happens is that the value of goodwill will go down because NCI is not valued at fair value method. So when you do for proportionate share of identifiable assets value of NCI, the value of goodwill may go down, because NCI is also not valued at fair value method. So you just have to show the calculation and explain, properly explain what will happen and what will be the impact of this, which we will do it at last, because that's very simple. It's nothing complicated. So let's look at the first requirement, which is goodwill calculation. Goodwill calculation. So now, since I've read the question, I'm just going to expand the answering column, because it's going to be easy for me to look at the answer. So goodwill calculation, we start with first consideration that is paid. Now I would recommend all students to read the question before you start watching the answers, so that you can have a very clear idea of what are the calculations I'm doing. Note down the adjustments very clearly. I'm not going to repeat those adjustments, but as and when we are doing the answers, I'm going to explain those adjustments. So the considerations are divided into two parts. One is a cash consideration, a deferred cash consideration, and a share exchange, which is very clearly written over here. If you look at here, on 1st January, Persistent Pharma acquired 80% of Smart Pharma. The share capital consisted of 7 million share issue of $1 each. Persistent Pharma settled these consideration by issue of 2 new shares in exchange for every 5 shares it acquired. Right? So first is a share exchange. So when it comes to a share exchange, what was the ratio of share exchange? Persistent shares settled the consideration by issuing 2 new shares in exchange for 5 shares. So Persistent is acquiring Smart, P is acquiring S, right? P is acquiring S. So I'll maybe write it down over here in your. I like to do the workings side by side. You can do it also in the bottom, but for the simplicity's sake, I'm going to do it on the side, so that you can see it, and I don't have to toggle down and up. So I'm gonna show it here. So first is, working note number 1. I am going to use the group details. So P acquired S, 80%. So NCI is 20%. 20% is NCI. So there is a share exchange for 2 for 5 shares at 80%, right? And what is the number of shares S consisted of 7 million shares, which is very clearly written. So I'm going to mention it as 7,000 multiplied by what is the market value of P company, because when it comes to share exchange, the value of the shares the shareholders will get will be of the P company. So the market value of P company share exchange is 6.5, right? 6.5. So all the information I took right now is consisting in these two sentences. Which are in green, right? So yeah, and from here, so $6.5, 6.5. Now 2 by 5 into 80% into 7,000 into 6.5 is 14,560. Is 14,560, and this amount, always put this over here, because it's very important you give headings. Otherwise you might lose some marks, because your examiner doesn't understand. And these are the reasons why students might be in the range of 40 to 50 or 45 to 50, or in fact it could be one of the reason why you are not scoring 49 and 50 and you're staying at 49. So they might say, oh, they might not put dollar thousands. You might get some additional marks for all these things because you are displaying it very well as a professional. Deferred cash. So deferred cash consideration you have is a further consideration was payable on 31st December X4 at 3 per share acquired. So you acquired how much, right? A further consideration was payable on 31st December at 3 per share acquired. So again, how many shares did we acquire? We acquired 7,000 shares. What was the percentage of acquisition? 80% is the acquisition. And what is the amount that we agreed to pay? 3 per share. And then since it's a deferred consideration, you have to discount it, right? And what is the discount value? For if you look at here, the cost of capital is estimated to be 10%. So the cost of capital is 10%. So in 1 year, it's in 2 years, because our current date is 1st January 2003. On that date is when the Persistent is acquiring Smart. So since we acquired on 1st January 2003, so 31st December X3, 31st December X4. So there are 2 years. So discount factor for year 2 is how much? 0.826. So that is 0.826. So 7,000 into 80% into 0.826 into 3. And that is 13,877. 13,877. So total will be 28,437. This will be our consideration. Then comes NCI. So NCI, if you know, we acquired parent at 80%, NCI will be 20%. Of how many shares? 7,000. So that's the number of shares which is in issue. 7 million shares. And what is the fair value of NCI? If you come down, it's very clearly written. Yeah, it is policy. When it's valued at market value, the market value of Smart company is $4. So hence we will value it at $4. So 20% into 7,000 into 4, which is 5,600. That is the value of NCI. So in total, the value of company will become 62,474. 62,470. It should be just 28 million plus 5,600. That is 34,037. It should be 34,037 is the total value of the company. From this, we will reduce the fair value of net assets of Smart. So fair value of net assets, what we can do is, since it's a separate question, we can create another working. Okay, let me just put this as 1 over here and 2. This working for fair value of net assets. Fair value of net assets. Okay, so fair value of net assets, what all should be included? Fair value of net assets should include the share capital, which is definitely mentioned as 7,000. Then retained earnings of Smart. Retained earnings of Smart. Retained earnings of Smart. If you look at the retained earnings of Smart, So that is divided into two parts. One is, if you look at this particular highlighter, which is in blue, on we have been given the retained earnings till 1st October 2000x2. So till 1st October 2000x2. So till October 1st, the retained earnings is 12,000. October 1st, the retained earnings is 12,000. Sorry about that. 12,000. And then the acquisition date is 1st January 2003. So which means October, November, December, January. So we need to get October, November, December for 3 months. 1st January 2003. So October, November, December. The 3 months profits we need to calculate. What is the profits for 3 months? If you look at the total profit for persistent pharma, smart pharma is 4.6 million, which is for 12 months. So 3 months profit will be very simple. So profits post, you can say from 1st October till 31st December. 1st October till 31st December, it will be 4065 into 3 by 12. So 4065 into 3 by 12. So which is 1016. 1016. Then to this we need to do some fair value adjustment. So we have got the retained earnings. Which has been calculated as till 1st October is 12,000. From 1st October till 31st December is 1016. So total is 13,016 is the total retained earnings. And then there has been some fair value adjustments, right? So if you look at here, the first adjustment itself is clearly explains that there has been a fair value adjustment to an item of plant which is in respect to 4 million. So let's create the next working. I'll just do it in here, which is fair value adjustment. The reason why I'm doing it now itself is that I know this adjustment will be required in my next calculation for profit or loss, and it will be required for my statement of profit or loss, or if it was balance sheet, then also statement of financial position, then also for retained earnings, this adjustment will be required, because depreciation is an expense which will be charged to retained earnings, also will be charged to profit or loss. So here we will take the fair value adjustment at acquisition, then we'll have the movement, and then at closing. We don't need closing because we are not preparing financial position, but it's easier for me this way. So with the fair value of plant, which is having a 4 million increase, and what is the movement? If you look at here, the movement at the date of acquisition was 4 years, and depreciation is to be charged to cost of sales. And what is your post acquisition period? So P acquired S on 1st January X3, if I'm not wrong, yeah, X3. And your year end is you're preparing this for 30th September X3. So 30th September X3. So the post acquisition period will be from 1st January to 30th September. So January, February, March, April, May, June, July, August, September. 9 months. And pre-acquisition period. So post-acquisition will be, I'll put it over here as post-acquisition is 9 months. Or in fact, I can put it over. Yeah, I'll put it over here. So post-acquisition period is 9 months. And pre-acquisition period. So pre-acquisition will be 3 months. Pre-acquisition will be 3 months, which is from 1st October to 2000x2 to 30th December 2002. That will be your pre-acquisition period. So here depreciation movement will happen only for 9 months. So what is your useful life, remaining useful life? So remaining useful life is how many years? Okay, I'll put it over here. Remaining useful life is 4 years. So depreciation per year for each year will be 4,000 divided by 4. So that is 1,000. So depreciation for 9 months will be 1,000 into 9 divided by 12. 1,000 into 9 by 12 will be the depreciation. That will be 750. So here the movement will be 750 and this will go to cost of sales. Okay, this will go to cost of sales. So your closing value of this asset will be 3250. Cost of sales. So there was an item of plant. So fair value change on plant, which is given in working 3, which is 4,000, is what we are required to add. Okay. Then what happened? Is that all? No. If you look at here, there was a contingent liability of 250,000 which had a fair value of 125,000 according to the evaluation done by Persistent Pharma. This had not changed on 30th September. So contingent liability, what happens to when there is a fair value change on plant? The net assets of the subsidiary will increase. When assets value increases, net assets increases. But this is a contingent liability which is valued at 125,000. So when liability increases, what happens? Your value decreases. So less contingent liability. What is the value? Value is 125,000. So 125 will reduce your net assets value. In this we don't need to calculate the movement because it says that it is not changed. And since we are preparing profit or loss, we don't need to worry about it. So what is our total fair value? Our total fair value of net assets, total value of net assets is 23,891. This is the total value of net assets, fair value of net assets. Total fair value of net assets is 23,891. So you show this as negative 23,891 will be the fair value of net assets. So what will be the value of goodwill? The value of goodwill will be 10,146. 10,146 will be the value of goodwill. And if you note or if you have read the 7th point, you know that the goodwill has been impaired. The goodwill was impaired by 25% by 30th September X3 and is to be charged to admin expenses. Less impairment of goodwill is 25%. So 10,146 into 25% will be 2,536. Okay, and if you look at here, the number is 2,536 point, yeah. So 2,536. So the total value of goodwill is 7,609. 7,609 will be the goodwill as at 30th September 2000 X3. 7,609 is the value of goodwill. So if you have done this and you have shown this working till here, you would be getting 4 marks because you are required to show how did you get 23,891. So that will be in working note number 2. Always whenever you are writing something, show the working or write it as a working so that everybody, the examiner knows. Examiner knows what you are required to do. Okay. Yeah. So after this is done, the next question that we are going to do will be to prepare the consolidated statement of profit or loss. Consolidated statement of profit or loss for the year ended 30th September 2000x3. 30th September 2000x3. Right? Okay, so which means we have the first one will be revenue, and in revenue also we have to do certain adjustments. Okay, and also since this acquisition is during the year, which means in middle of the year we have to accrue these for 9 months. Every time we take revenue of the subsidiary or cost of sales of subsidiary, we have to accrue it by 9/12. And there has been some intra-group trading which will need to be removed from the revenue as well as from the cost of sales, and unrealized profit should be added back. So that's the adjustments we may have to do. So let's first look at the revenue, and the revenue of the parent company Persistent is 45,000. So 45,000 plus the subsidiary company's revenue is 27,000. So 27,000 means the post acquisition period is only 9 months. So 27,000 into 9/12 we have to do. And then what we need to do, if you look at here, the adjustment which is point number 4, there is a post acquisition intra-group trading. So that we need to reduce. So if you look at point number 4, intra-group trading. Okay, intra-group trading, which is mentioned here as post-acquisition intra-group trading, is at the rate of $250,000 per month at the gross margin of 25%. So per month intra-group trading is equal to 250,000. So post acquisition period is 9 months. So total intra-group trading is equal to is 250,000 into 9, and that is 2.25 million. So we will write it in thousands. So we'll put it in thousands, divided by 1000 is 2250, and this amount should be reduced from revenue as well as should be reduced from cost of sales. So 2250, working note number 4. So if you mention the working note, it will be easier for the examiner to understand where you have referenced it. So that's how we need to mention it. So the heading is in dollars, $1,000. So 45,000 plus 27,000 into 9/12 minus 2250 is 63,000. Then you reduce cost of sales. Cost of sales of parent is 24,750. Okay, plus subsidiaries 18,900. However, into 9/12. Then what we need to do? We need to reduce the cost of intra-group revenue trading amount, which is working note number 4 that has already been mentioned. And then to this we need to add the unrealized profit. So what is the unrealized profit amount? Unrealized profit, if you look at the point here mentioned, goods worth 300,000 were included in the inventory. So goods worth 300,000 were unsold in the inventory, and profits of unsold inventory will be the unrealized profit. So unsold product unrealized profit will be equal to unsold inventory, which is 300,000. Okay, and that is a profit margin of 25%. So it's a margin of 25%. So when it comes to margin of 25%, what we need to do, how will we calculate it? It's very simple, right? Because the value of 300,000 is also at the selling value, and margin means sale value is 100, cost is 100 minus 25, 75. So which means unrealized profit will be equal to 300,000 into 25%, which is 75,000. So the 75,000 will have to be added back. 75,000 will be added back. So add plus 75,000, which is working note number 4, and then what we need to adjust for, if you look at our previous example, there has been a depreciation, which is depreciation on plant. So the depreciation on plant will have to be adjusted in this, because it's mentioned over here that the plant had a movement of depreciation on 750, and as you can see, the depreciation is to be charged to cost of sales. So this, which we calculated for our previous part, which is part A, 750 will have to be adjusted in the cost of sales. So 750 should be added to the cost of sales. Cost of sales should increase. So worth 750, which is in working note 3. So what will be our total amount? Our total amount will be, okay, 24,750. Okay, all of them should be negative. So the easiest way for you to convert everything in negative is put a negative symbol, open up a bracket, 24,750 plus 18,900 into 9 by 12 minus 2250 plus 75 minus add 750. What would you get? You will get 37,500. That will be your cost of sales. So your gross profit will be 25,500. That will be your gross profit. The next one is sales and distribution tax. And sales and distribution tax, there is no adjustment that is required. So sales and distribution cost. So the parent is 115 plus subsidiaries 1325 into 9 by 12. So which means the total will be 1115 plus 1325 into 9 by 12. That will be 2109. The next one is administrative cost. What is administrative cost? Administrative costs are those costs that you incur in the company because of managing the business. So when it comes to administrative cost, what all does it include? Right, so we need to identify what are the factors that could include over here. Definitely the parent plus the subsidiaries 9 by 12 you have to add. And also, if you look at here, in last part, we did an impairment of goodwill to the extent of 2536. This amount will go to admin expenses. So that should also be included. So the next one will be administrative cost. So parent, administrative cost in parent, which is 2650 plus 1660 of subsidiary into 9 by 12. To that, what do you do? Add the amount, which is 2536, and that you can represent to question A. So how much will it be? Which is 2650 plus 1660 into 9 by 12 plus 2536. So total amount should be 6431. That should be your total amount. So that also you have got. The next one is finance cost. Now when it comes to finance cost, you need to be careful here. Why? Because there are few items which need to be adjusted. Because if you look at here, there is something called as investment income. What is that investment income? If you look at the next working, which is question number 5, Persistent Pharma had issued $1,000 5% convertible loan notes. Now this is something that's very rarely asked in a consolidation question, because in consolidation question they don't ask standard related items. They ask adjustment related items but not much of a standard related items. But in this question they have asked something which is from our IFRS 9 accounting standard, where Persistent Pharma have issued a convertible loan note. Now when it comes to a convertible loan note, what will be the impact? When convertible loan note is issued, it means that there will be a liability component and as well as an equity component, and the liability component interest will have to be calculated, because the liability component will definitely go through an interest expense, and that interest expense will need to be charged to P&L, and that liability component that will be need to charge to the P&L. Also, there is another factor which will be required to charge into finance cost, right? So this just to continue, this liability components interest portion will be charged in P&L as part of finance cost. Further, in addition to this, we issued a deferred consideration. The parent company issued a deferred consideration. So because of deferred consideration is issued, what happens? Because a deferred consideration is issued, what happens is that the unwinding of discount, which is the present value of the deferred consideration multiplied by the cost of capital of 10%, that amount will need to be mentioned as an interest expense in your finance cost. So these two issues are there which we need to adjust in our finance cost. And in finance cost, there is an error the company have made. What is it? If you look at the last sentence, Persistent Pharma had recorded the liability at par value and recognized the interest payment of 5%. So that is wrong. So they have already charged some portion of interest. We need to adjust and this particular amount either to increase the interest or reduce the interest, depending upon what is the actual interest as per our convertible loan note calculation. We need to calculate that. Technically it will be lower. This amount is at 5%, so the value of interest will be lower, because the interest we need to charge will be at an effective interest rate, not at an actual interest rate. This is actual interest. So the Persistent have already charged to P&L an actual interest, which is not correct. We need to charge an effective interest. So look at this situation. Okay, let's look at the working. So working note number 5, which is called as unwinding of working note number 5 is convertible loan note. So convertible loan note, we have to find out the liability component and take the interest charged to P&L, right? And whatever the interest already charged, we need to remove that and then take the additional interest that's required to be charged. So how do we calculate the liability component of the convertible loan note? We using the cash flow method, the discounted cash flow method, right? So we have interest. Okay, what is the interest? If you look at the interest, it is 3,000 into $1,000 multiplied by 5%, correct? So 3,000 into $1,000 multiplied by 5%, which means $3 million. 3,000 into $1,000 is 3 million. $3 million into 5%. So I'll put it in, I'm mentioning it in dollar thousands, okay, which is $3,000 into 5%, which is 150, correct? So $3,000, 3 million into 5%. I can also, if you have not understood, this into 1,000. 3,000 into $1,000, which will be 150. What is the discount factor at 7%. What is the discount factor at the effective interest rate? Discount factor at an effective interest rate. Okay, what is the annuity factor we need to consider? Because it is an interest, for how many years we are issuing this convertible loan? If you look at here, the convertible loan is issued on 1st October 2000 X2 and it is for a 5-year period. So 7% for an annuity factor of 5 years is 4.1. It is 4.1. So take discount factor as 4.1. So which means the present value will be equal to 150 into 4.1, that is 615. And at the end of the 5th year, we need to pay out the principal value also. What is the principal value? 3,000. $3 million will be the principal value. And when we pay out the principal value at the end of the 5th year, what is the present value of that particular amount? The principal value of the convertible loan note to be paid at the end of the 5th year. What is the present value of that? 0.713. So 3 million into 0.713 will be 2139. So the total value of the liability component will be 2754, which will be 2754. Now the interest to be charged, right? So interest charged to P&L, the interest that should be charged to P&L, which is at what rate? At 7%, which is 2754 into 7%, and that will be 193. So interest to be charged to P&L is 7% is 193. Interest already charged. What did they do? Interest, what did they do? Very simple. They took the nominal value of the bond, which is convertible loan, which is $3,000 or 3 million, and multiplied with what percentage? 5%. So 3,000 into 5%, and that is 150. This is what was charged. So the additional interest to be charged is 193 minus 150, and that is 43. And that is 43. This is the additional interest that should be charged. Additional interest should be charged is 43. So this additional interest, what we should do? This additional interest, we should add it to our finance cost. The additional interest should be added to the finance cost. This is one adjustment that we need to do. The second adjustment that we need to do, is unwinding of discount. So 6, unwinding of discount. So unwinding of discount, what was the present value of the consideration, deferred consideration? Present value of deferred consideration. The present value of deferred consideration, which we have already calculated when calculating the goodwill, is 13,877. So 13,877 is the present value of deferred consideration, and we discounted this or calculated this value 13,877 using cost of capital of 10%. So interest on deferred consideration, which is unwinding of discount, and that will be done at 10%, which will be 13,877 into 10%, which is 1387. However, when did we acquire the company? We acquired the company on 1st January 2000 X3. What is our year end? 30th September. So this unwinding of discount at 10% should be accrued only for 9 months. So into 9 divided by 12, which is 1041. So the calculation is 13,877 into 10% into 9 by 12. So which will be 1041. This should also be charged to our finance cost, right? So debit finance cost as 1041 and credit deferred consideration liability, deferred consideration as 1041. So your value of liability at the end of the financial year will increase by 1041. Your finance cost will also increase by 1041. So finance cost will include what all item? 300 of the parent. There is nothing of the subsidiary. So that you don't have to adjust for. However, for the convertible loan note, you need to add 43, and you can reference working note number 5. Again, add 1041, which is working note number 6. Working note number 6, 1041. So total value will be 300 plus 43 plus 1041, which is 1384. 1384. So the next is income tax expense. So income tax expense will be of the parent is 2285 plus subsidiaries 1050 into 9 by 12. So 2285 plus 1050 into 9 divided by 12. So total is 3068. So which means our net profit after tax, and this is profit before tax. So profit before tax will be 15,576. Profit after tax will be 12,509. 12,509. 10502285. It should be 85. Okay. So 12,509. Yeah, this is fine. And then we need to distribute this profits attributable to owners of P and NCI. Profits attributable to owners of P and NCI. So in this situation, we need to calculate the working for NCI. How will we calculate the working for NCI? NCI will be, first we need to take the post-acquisition profit of subsidiary company. What is the post-acquisition profit of subsidiary company? The total profit for the year is 4065. However, we should take only for 9 months. 4065 into 9 divided by 12 into 9 by 12. So 4065 into 9 by 12, which is 3049. Then we will remove the unrealized profit which we calculated. The unrealized profit element which we calculated, that is unrealized profit is 75. It's not 75,000, it should be 75 because all the numbers that we are mentioning over here are in thousands. So we need to remove 75,000, and then excess depreciation on plant should be reduced because plant fair value changed. So because of that, depreciation also would have increased. So 750 will be reduced. Then the goodwill got impaired. So goodwill impairment should also be given to NCI because NCI is valued at fair value. So in that case, when there is impairment, some portion of impairment should be charged to NCI as well. So what is the goodwill impairment amount? the goodwill impairment amount is something that we calculated is 2536. 2536. 2536. And then adjusted profit. Adjusted profit will be equal to all of those added together. That will be 313. Of which the NCI share was 20% to non-controlling interest. 3112 into 20%, which is 62.54, that is 63. So that will be 63. So 63 will be the NCI share of profit. So NCI share of profit is 63. So from this we will reduce, or from the owners of parent we will reduce 63. The total profit is 12,504. So from 12,504 we will reduce 63. We will remove 63. We will remove 63. In that case, what happens? So 12,504 minus 63. So 63 is not a profit. NCI is a share, is a loss. Why? Because the subsidiary company, after all the necessary adjustment, ended up in a net loss. So here it is not adjusted profit, it will be an adjusted loss, net adjusted loss. Why? Because from our 9 months profit, we remove the unrealized profit, we remove the excess depreciation, because all these are intercompany adjustments. We removed the impairment, goodwill impairment. What happened? Everything ended up last at a loss of 313. Now this loss will go directly to NCI. So NCI's balance will actually reduce by 63. So 20% loss NCI to NCI, the loss that will be accrued. So that will be 63. So now for owners, from the total net profit of 12,504, we need to remove the 63, which means owners which will be attributed will be 12,566. So as you can see, owner's profit is actually 14,500, and because of the subsidiary, the owner's value is actually reducing to 12,566. So which means the loss of the subsidiary is also absorbed by parent, whereas NCI will have only the loss of the subsidiary, and hence it is negative 63. So the net amount total will be 12,504. 12,504. This is how the attribution should be shown. So with this, you will also be able to gain 12 marks. So total of 12 marks you will be able to generate. The next question will be for section C. When we value NCI at proportionate share of net assets basis, what will be the value of goodwill, which is pretty much straightforward and easy to calculate. So now let's look at the question requirement number C, which is goodwill calculation using proportionate method of for valuing NCI. So I have already mentioned to you or confirmed to you that when a goodwill is calculated using the proportionate share of identifiable net assets, then the value of goodwill will go down. If you are valuing the goodwill at any fair value, then definitely the fair value will include some goodwill to the NCI, whereas the proportionate share does not. So hence the proportionate share will reduce the value of the goodwill. So first point is something that we need to write is about that. So the value of goodwill is will be lower when the NCI is valued at proportionate share of net assets method compared to fair value method. So the value of goodwill will be lower when the NCI is valued at proportionate share of net assets method when compared to the other method, which is the fair value method. Now in case of and why this happens, so we need to explain why this happens. So we can say that this is because the fair value method allocates some portion of goodwill to NCI as well, whereas the proportionate share of net assets method does not. So this is the reason this particular issue happens. So let me just try to merge this. How do I merge this? Format. Wrap text. Okay, so we have to do a wrap text rather than to merge this. Okay, anyway choice. Now the next sentence that we need to talk about is when it comes to the proportionate method, goodwill will not be the NCI, the goodwill impairment will not be charged to NCI. So however, when we value the NCI at fair value method, then the goodwill impairment will be charged to NCI. So we need to mention that part as well. So in case of proportionate share of goodwill method, NCI will not in the case of proportionate share of method, when goodwill is impaired, the impairment amount or impairment loss is not allocated to the NCI. So in the above case, the goodwill calculation using proportionate share of net assets method will be as follows. That will be the case. Okay, so how will we calculate the goodwill? So let's look at here. So goodwill will be everything else remains the same. So total consideration as per A. So we can take from working A calculation our total consideration, which is 28,437. Okay, take less fair value of net assets. That will also be the same, which is how much? Which is 23,891 will be fair value of net assets. Only thing will change is NCI. NCI will be so that will be 23,891 into 20%. So 23,891 into 20% will be 4,778. So hence the difference between all, the goodwill amount will be, total amount will be 9324. That will be the goodwill amount. Now yes, it will go for an impairment. So impairment loss will be shown, which is less impairment 2356, and the goodwill amount will be shown after the impairment loss. So the amount of goodwill 2.52536 will be reduced for the total amount of goodwill that we have calculated. However, this amount of goodwill, this amount of impairment will be taken directly from our directly to our group, and it won't be taken to NCI, because NCI does not have goodwill allocated to them. So NCI's value should not reduce. So the impairment loss again will be the 20%. So that's how it will be calculated. However, the goodwill before impairment is 9324. after goodwill before impairment for the fair value method is 10,145. So as you can see, the value of goodwill as per proportionate net assets basis is lower. Let's now go to the last question for this mock exam, which is question number 32. This question is based on ratio analysis. As you can see, the question is total of 20 marks and 2 requirements are there. 8 marks for calculation of all the ratios as of 30th September, which are shown as per the sector average. Second will be for 12 marks, using the calculation of ratios, analyze the financial performance and financial position of the company. So we need to explain in 2 ways. One is performance and position. When it comes to performance, it would include like gross profit margin, operating profit margin, then the return on capital employed, receivable collection period, etc. But when it comes to financial position, it includes like in performance we should include interest cover rather than receivable collection period. And when it comes to position, we should explain about the gearing ratio, current ratio, inventory holding period, receivable collection period. You can also talk about interest cover, which explains whether the company is having any liquidity or cash flow issues. So let's now look at the first requirement, that is to calculate ratios for the year ended 30th September 2003 as of the sector average. So for that, let's look at read the entire scenario in full. Super Goods is engaged in manufacturing of home appliances, which it distributes through a network of dealers and departmental stores throughout the country of Zealandia. The market of home appliances is very competitive. Okay. So firstly, if we want explaining about the financial performance and position of a company, you need to very clearly understand the kind of risk that will get associated with the kind of manufacturing or the kind of business the entity is doing. So Super Goods is very clearly, as mentioned, is manufacturing of home appliances, and they distribute it through a network of dealers and departmental stores. So which means they supply, they are manufacturers and they supply to their dealers, and the dealers will supply to their retailers. So what will happen? Technically, when they supply to the dealers, definitely there will be receivables, because the dealers are not going to pay upfront and they won't pay for the entire stock, etc. So there will be kind of receivables. Second, what will be the issue? Second major issue that could happen when it comes to distribution through dealers and departmental stores is that there will be liquidity issues as well, because the company are manufacturing and they are turning over the inventories. So they could engage or end up having liquidity issues. Third thing is that they have to have a lower profit margin. Why? Because dealers also have to make money. So when they send it to, when they are selling through direct retailers, through their own dealers, or through their company based dealers, then they can have a higher margin. But since they are sending it to their wholesalers or dealers or departmental stores, then what happens is that their margin will have to be reduced so that the dealers and departmental stores can also make money. So their operating profit and gross profit margin can also be reduced. So they have given us the sector averages: gross profit margin, operating profit margin, interest cover, gearing ratios, etc. And extracts from the financial statement for the year ended 30th September are given. So revenue is 120,000, cost of sales is 78,000, gross profit is 42,000. So seems to be good amount of gross profit. Why? Because if you look at 1,20,000, approximately 50% to the case of 50% is getting generated in margin, and it seems that sector average is 45%. Operating expenses 28,800, operating profit is 13,200, finance cost is 2.95 million, profit before taxation is 10 million, taxation is 2 million, profit for the year is 8.2 million. So which means the company is profitable. That itself is a good sign. It's a positive sign. However, when you compare to the sector averages, only then you will be able to say whether you are actually doing good compared to other companies in the industry. And it's very clearly mentioned that it's highly competitive. So definitely, if you are not doing well, then there could be cases of issues that you could follow. Then there are assets given: property, plant and equipment 50,500, intangible assets 7,500, note is given, inventory is given, trade receivable is given, equity shares, revaluation surplus, retained earnings, non-current liabilities, borrowings at 8% is also given. Trade and other payables, overdraft is also given. So they are having a negative cash flow if that's the case. Why? Because they are having an overdraft of 16 million, which is 50% of their borrowings, which seems to be very high, very, very high. And if you look at their receivables, the 17.500 million. So altogether, they do not have cash of close to 32 million. 32 million of cash is stuck because they have overdraft which they have to pay, and 17.500 million we are not going to receive it. So that's a big red flag. Okay. Then current liabilities is 2.05 million, and they have trade payables also 15.4 million. The PPE includes property acquired by Supergoods some years ago. The property has been recently revalued, which has resulted in revaluation surplus shown under the equity. The plant and equipment have been in use for many years, and the company is now considering to replace it with modern equipment, which would enhance quality and efficiency. The intangible assets include patent. The life of patents among 6.5 million would expire in next 2 years. So what does it mean? Which means that they either have to file the patent. For that they might have to pay good amount of legal fees. Second is that 6.5 million their patent will be lost, so they might have to do something with respect to this. Their patent can be copied by other people or other people in the industry. The company supplies majorly through the dealer network, which is 80% of its sales on an average. The balance comes from retail sales. So basically their major sales come from dealers, so definitely receivables as well as margin could be lower. The industry has shifted to retail sales in the recent past. So which means the entire industry have directly now selling to the retailers, but we are selling through dealers. That's one of the reason why our receivables as well as overdraft is quite high. The company paid a dividend of 4.5 million in the current year. Some directors have questioned the propriety of this huge payout that increase of bank overdraft. Absolutely correct. If you look at the profit is 8.2 million, the dividend payout is 4.5 million, which is close to 50%. 50% of the profit have been paid out as dividend, which is really questionable, because if this had not been paid out, or at least 1 million or 2 million had been paid out, our overdraft would be much lower. And the question is, was this in the past the continuous pattern that the entity have shown, which has resulted in a huge overdraft in the company? So that have to be checked out. So these are the issues that we can see from the notes, and these notes have to be used when you are explaining your answer. So now let's first is to calculate the ratios. So we can, since it's a calculation, we can insert a table. So generally what we will do is we will insert a table with, so I have inserted a table. I went to table and then selected 9 rows and 4 columns. Okay, so the first column will be the ratios, the headings of the ratios that I am going to calculate. Okay, the second column will be the working. The third column will be of the company, which is Supergoods company, and the fourth column will be sector average. So I can create bold. In fact, if I want italics, I can do italics, whatever, as an option. The first one is gross profit margin. Gross profit margin, how do you calculate? Gross profit divided by revenue. So 42,000 divided by revenue of 120,000. So what is a margin? 42,000 divided by 120,000 into 100 is 35%. Whereas if you look at the sector average, it is 45%. So which means it is 10% lower. So the reason why the margin is lower is something that's mentioned over here, right? So the company sells 80% of their sales through dealers, whereas the industry has shifted to retail. So when they are retail, the profit margin would be very higher. Whereas when you're selling through a retail, he also needs a margin. So that margin will go to him. So that's why if you see, our margin is a bit lower compared to the sector averages, right? So that sentence is very important now, and that we need to write it. The next one is operating profit margin. Operating profit is 13,200. Okay, it's very clearly given, 13,200 divided by 1,20,000. So that will be, let's open the calculator. Okay, yeah, 13,200 divided by 120,000 is 11%. 11%, and here it is 17% operating margin. The next one is interest cover. Interest cover is basically total amount of our operating profit divided by the interest amount. So what is our operating profit? 13,200 divided by what is our interest amount? Finance cost is 2,950. So 2,950. So 13,200 divided by 2,950. 2,950, that is 4.5%. Whereas the industry average, if you look at here above, industry average is 8.3. So what does it indicate? When it comes to the interest cover, if you look at the number, interest cover is 4.5 versus 8.3, but it doesn't mean that it is actually good. Why? Because if you look at interest cover, the operating profit margin of the entity, which is only 13,200, which means they have only a coverage of only 4.5, which means only 13,200 can bear up to 4 times interest that they are paying. Whereas if you look at industry average, 8 times, even if the interest increases by 8 times, the industry will have that much of profit to cover those interest payments. Whereas for super goods, they do not have enough profits to cover their interest. Only 4.5 they can cover. So only interest up to 4.5 times they can cover. So if the interest increases by 4 times or more than 5 times, the entity will not have enough amount of profit left to cover these interest, and that's going to be an alarming situation. The next one is gearing. Gearing is debt by equity. Debt by equity. So that's what is mentioned over here. So what is our total debt? Our total debt, which is given over here, is 28,000. So 28,000, total non-current liability is 28,000 divided by total equity is 33,500. 33,500. So 28,000 divided by 33,500 is 83%, or it is 84%, 83.6. We can put it up to 1 decimal point, 83.6. What is the industry average? If you look at industry average, it's only 40%. It's only 40%. Gearing, we are very high geared, and this is a very big alarming situation. We need to write at least a big note about this, saying that no, this seems to be really alarming, because the company will have liquidity issues or cash flow issues going forward. And if you look at here, the gearing ratio is very high. The company is having negative cash flow or overdraft, so that also is an alarming situation. The next one is current ratio. Current ratio, you know the formula, which is current assets by current liabilities. What is our current assets? Our current assets is 37,500 divided by current liabilities is 34,200. 34,200. So the total amount will be 37,500 divided by 34,200. So that is 1.09. Okay, or you can put it as 1.10 is to 1. Whereas sector average is 1.75. Again, very poor. The financial position of the companies seems to be very alarming. Why? Because their current ratio is also very bad. They will be having liquidity issues. The next one is inventory holding period. The formula for inventory holding is amount of inventory, which is 2,200, that is given over here, divided by the cost of sales, which is 78,000. So 78,000 into 365. So the answer will be 2,200 divided by 78,000 into 365. which is 94.5 days. So what does it mean? I'll put it as 95 days. So what does it mean? It means that it takes 95 days for super goods inventory to be sold into the market. It takes 95 days. What is the industry average? Industry average is only half, 45 days. It should take only 45 days for super goods to sell their product, but it's taking them 95 days. So what does it mean? It will lead to a situation for them further liquidity issues or further cash flow issues. Why? Because when they are taking more time to sell, the more amount of time it will take for the money to come back into their business. Then receivable collection period. Receivable collection period. If you look at receivable collection period, the amount will be total receivables is 17,500 divided by revenue, which is 120,000 into 365. So that will be 17,500 divided by 120,000 into 365. So that will be total 53 days. 53 days. What is the industry average? Industry average is 25 days. Again, half of it. What does it mean? It takes 53 days for your dealers to send us the money. Whereas when it comes compared to the industry, it takes only 25 days. And why it takes only 25 days? Because majority of the industry are selling to their retailers, not to the dealers. Because we are selling to the dealers, dealers will take more time to settle us the amount. Because they have to sell it to the retailers and retailers have to pay money, and the payment will receive us, it will take time. It will definitely take a lot of time. Then we have return on capital employed, ROCE, return on capital employed, which is our operating profit 13,200 divided by total capital employed. What is our total capital employed? Our non-current liability, which is total equity, which is 33,500 plus our non-current liability. So 28,000 of non-current liability, which is long-term liability of 28,000 plus equity is 33,500, or total assets minus our current liabilities of 34,200. You will get the same answer. So return on capital employed is 13,200 divided by 33,500 plus 28,000. So which is 21.5 percentage. What is the industry average? 29.4%. So again, very poor. So which means on all aspects we are very bad compared to the sector average. So the performance of the company is not up to the mark. Definitely the gross profit margin is lower. ROCE will be lower because definitely their operating profit will be also lower. Operating profit margin is also lower. The reason is because they are not able to charge higher margin to their dealers, because their 80% of their sales is from dealers. So that's one of the primary reason. So what I would suggest you to do is write your answer based upon this factor. Pause the video now and write your answer. And once you have written your answer, then let's try to explain. I will try to explain. Right. So the next point, before you start, just pause the video and write your answer. So I'm going to put it as analysis of financial performance and position of super goods company. So just write your answer, and before you write your answer, ensure that you have done the calculations, read the scenario very well, and try to explain it in 3 ways, and try to answer in 3 questions: what, why, and how. Like, what is the issue that the super goods is facing, why they are facing this issue, and how can they rectify it. On going forward, how can they better their ratios. If you write it in these 3 ways, it will be easier for you to explain the situation and you'll be able to answer it very well. And take the performance, ensure that you have sentences, at least 2 sentences for each of the ratios. So talk at least 2 sentences about gross profit margin, So you can say the gross profit margin is comparatively 10% lower compared to the sector averages. The reason could be that they are selling primarily through dealers who will take a lot of percentages. Operating profit seems to be very low, only 11%, whereas the sector average is 17%. We don't have a split of the operating expenses, so we don't know what is the situation. Further, we don't have the split of the 80% sales comes from dealers, 20% comes from retailers. So we don't know whether the company is actually having better profit through dealers or retailers. That split, the revenue split through the percentage of dealers versus 20% on retail, they are not given. So hence we cannot comment on that. So operating profit margin, we also don't have information related to operating expenses. So we cannot comment on that as well. So it could be that the operating expenses could be very high. So those kind of answers you use and try to explain it what, why and how. So let's now write the analysis of the financial performance and position of the company. First, I'm going to write about the performance of the company. So when it comes to the performance, as we have already explained, all of their ratios are looking very bad. And specifically when it comes to their performance, gross profit margin and operating profit margin are lower than the industry average, also rose. Further, this could be due to the fact that they are having 80% of operating capacity through 80% of their operations through their dealerships. Further, the PP they have acquired is actually quite some time back. So in the capital employed will be at a carrying amount which will be very low. So definitely the capital employed will be low. So the ROS could be higher. But if the replaced with a new machinery, definitely the ROS could go down. If you look at here, the company is actually have it for many years, and the company is now considering to replace it with modern equipment which could enhance quality and efficiency. So which means the PPE which is actually they're using right now is of lower quality and as well as of lower efficiency. That could lead to the could also be an explanation for the lower gross profit margin, because lower quality means lower sales, and definitely lower efficiency means higher cost. The cost will increase because they won't be able to produce much. And that could be one of the reasons why their holding period is also very high, because it might be taking more amount of time to produce these. So when it comes to the performance, the first thing that we need to write is about the gross margins are substantially lower compared to the sector average. This may be due to the fact that 80% of the sales of super goods company are through dealer network, which would have lower margins compared to sales through retail sector. Further, since there is no data given on the sales, since there's no data given on this about the sales made through different channels, we cannot comment more on which channel provides better margins, right? Further, you can also say that further the PPE used by super goods seems to be very old and has an impact and could have an impact on the product quality, which is resulting in lower sales prices compared to the market and lower sales compared to the market. Further, the prices may improve if the PPE are replaced with new ones. So the next one is about as the operating profit margin. So as compared to GP margin, the gap between operating profit margin of super goods and sector average is relatively smaller. Only 6% is the gap. However, the operating profit margin is relatively very low and could be explained by lower GP margin or other or higher expenses and lack of control of these expenses. More light on the expenses breakup would have given better information. So we don't know what these operating expenses are. So if we were able to check these operating expenses, what they contain of, then we could have explained that this is the reason why the operating profit margin is relatively lower. Further, considering the PPE are very old, repairs and maintenance expenses could be one of the higher expenses that would need to be looked into. Okay. Further, there could be possibility of impairments of assets. So certain assets could have also impaired because they are quite old. Their assets value could be relatively lower. So we have talked about gross profit margin, we have talked about operating profit margin. The next one we need to talk about is ROS. Okay. So the lower ROS is due to the lower operating profit margins. However, it may actually seem higher due to the old PPE whose carrying amount will be lower, and hence the capital employed is relatively lower. Carrying amount is relatively lower. Once the fresh investment is made, the ROS could reduce, which is a red flag for the investors or shareholders. So if we replace the old equipments with new equipments, then the ROS could fall because the new equipments will increase the capital employed. So because of that, it could fall. And one thing that is not mentioned here is about the asset turnover. So if we mention about asset turnover, we could actually get more marks also, because ROS is always compared with asset turnover. So you can say that the lower ROS could also be explained by the lower asset turnover ratio. So if the asset turnover ratio is lower, then the ROCE could also be relatively lower. How do you calculate asset turnover? Asset turnover is calculated based on net sales, which is 120,000 divided by capital employed, which is 33,500 plus 28,000, and that is equal to how much? So if we take 120,000, okay, 120,000 divided by 33,500 plus 28,000. So total will be 1.95. So which is 1.95. So asset turnover is relatively lower. However, if you compare this ratio to the sector average, okay, let's try to compare this with sector average. Okay, so however, if we compare this ratio to sector average, what are we getting? What is the sector average amount? How do we calculate for sector average? It is very simple. Okay, we know the ROCE is 29.4. okay, and we know the operating profit margin is 17%. So 29.4, okay, 29.4 divided by 17%, which is 1.72. Why? Because why are we taking 29.4 ROCE divided by operating profit margin? Because if you look at here, operating profit ROCE is calculated by net the operating profit divided by capital employed. Operating profit margin is 13,200 divided by 1,20,000. So 13,200 and 13,200 will get cancelled against each other. 1,20,000 divided by 33,500 will remain. So that's why we are taking the ROCE divided by operating profit margin will give us asset turnover. So which is asset turnover. So it is slightly higher than the sector average, but if the assets of super goods are replaced, then the asset turnover could reduce and even below the sector average. So since the assets that we are using are old assets, the carrying amount of the assets would be very less. Why? Because we would have fully depreciated the asset. So if we replace it, then the asset turnover could further reduce. Now the next one is interest cover. As I have already explained, interest cover seems to be very much alarm to the fund providers or the debt providers. So the interest coverage of 4.5 for super goods seems to be very alarming for the loan providers. This ratio gives the number of times the entity is generating profits that could cover the interest expense, right? So this is what the this particular interest ratio says. However, the sector average interest cover is double than the super goods company. Hence, if they are not reviewed and maintained well by the entity, this could lead to risky situations for the entity, as they could be part of the debt covenants of the debt holders and their loans could be called upon. So basically, if they have taken a bank loan or a debt holders, there could be conditions or debt covenants like interest cover. They have to maintain an interest cover of at least 5, etc. So if that they are not able to maintain that, then definitely it could lead to a situation of where the entity would have to pay back the loan from the debt holders because or from the bank, because technically it could lead to situation where for the loan provider it's under risky issue because their interest cover is very poor. So we have talked about the performance. We have concentrated on gross profit margin, we have concentrated on operating profit margin, we concentrated on return on capital employed, as well as we have talked about interest coverage. Now we need to talk about the position of the company, and as we have already explained, the position of the company also seems to be very bad. Further, it seems to be they are having liquidity and cash flow issues because of their low and alarming current ratios and gearing ratios, etc. So the financial, you can write it by the financial position of super goods is under an alarming situations with their risky current ratio and very high gearing ratios could indicate the liquidity of the entity is under jeopardy. Okay, this is the opening statement that I would like to make. A higher gearing will have effects on the interest cover as well. Further, if these gearing ratios are not controlled, could lead to cash flow issues, and also any further borrowings might not be received by the entity. Further, the entity is trying to replace their assets, for which they need cash flows, and with their current situation it could be very difficult to raise the funds. Okay, right, so this is something that we have mentioned, and also I have to talk about their bank overdraft. Further to add the entities is having very high bank overdraft, and therefore entity may have to resort to leasing the assets rather than buying, to avoid raising huge funds. So they can still replace their assets, but they should try to lease the asset and sell off their old assets so that they can get some money and use that to lease the assets, so that at least their cash flow situations, until they improve, they should not try to further lead to those kind of problems. Further, in spite of having very less cash, a large amount of dividends have been paid. This could be due to the pressure from shareholders and shareholders and to protect themselves. Entities management would have decided to issue higher dividends. Further, this may not give good signal to the market, especially other fund providers like debt holders or bank borrowings. Further, it seems the shareholders are more interested to withdraw money rather than invest new to fund any asset replacements. So instead of keeping the money aside, so they could have kept instead of giving the dividends, they could have kept that money and kind of used it for asset replacement and then issue dividends in the next year. But considering this, they don't have enough money to even pay for the asset replacement, and a huge asset replacement would have improved their margins and better sales would have come in, and they could have better paid the dividends slowly to next year. And further, this could lead to a lot of cash flow issues for the company, because there will be huge payout of cash in next 2 years as the loan needs to be redeemed. So if you look at here in note number 4, the 8% loan were issued 3 years ago and would be due for replacement in X5, and currently it's 2000X3, 31st December 2000X3. So which means that the entity might have to pay out the loans in some time in near future, which is in 2 years. So if currently they do not have any entity, they won't be able to pay the loans. So there is no cash currently available, and it needs to see if the company is able to roll over the loan for a few more years. Otherwise they could lead to default of payments, right? Further, they might not be able to get loans also, because if they might not be able to get an extension also because of their higher gearing. So that due to the higher gearing and lower interest cover, it is unlikely the entity might receive loans, might receive extension of loans. Now, where is the entity's money is being blocked? They are profit making entity, they are making good revenues of 120 million. So where their money is blocked? If you look at here, their major money is blocked in trade receivables and inventories. So trade receivables and inventories is their major money blocked, and that is evidenced by the fact that inventory holding period is 95 days, more than double of the sector average, and more than double for their sector average for receivable collection period as well. So that's where their money is being blocked. So the cash availability is largely locked up in the inventories and trade receivables of the entities. This is evidenced by the double rates of double, I put it as double amount of double inventory holding period, I put it as inventory holding period and trade receivables period compared to the sector average. This could be due to poor controls on buying and collection strategies. Further, given that super goods sells 80% through the dealer network, the collection from dealers is probably not well managed, and we need more information to analyze whether there are any old inventories and as well as aging receivable balance, etc. More information of obsolete inventories and aging receivables could help us give more information. Further, if you look at here, that's one of the major two issues that they are not having better cash collections. And when we talk about the next aspect is something that's they have very clearly mentioned over here is about the patents. The patent life is amounting to 6.5 and would expire in the next 2 years. So this is another crucial point, because in the next 2 years when the patents would expire and they would not have exclusive rights for their technology and could face severe competition, considering they are in a competitive market, they could face severe competition. And there is no indication that there are development costs, there are development work being going on which could actually help us to replace these old patents. So if the patents are being not extendable, or if their patents are not valued, then definitely whether the entity could continue because their technology could be copied could also be under questionable condition. So we can write that the patents of the entity will expire in 2 years, which mean that super goods will not have any exclusive rights for its technology, and the competition may be fierce in 2 years. This could indicate this could lead to entity unable to protect their technology and could be easily used by other competitors in the market. Further, the entity is not developing anything new that could help them to sustain in the market. So this could raise doubt about their going concern status as well, because if they do not have any patents to protect themselves, then the competitors will automatically use their technology and use that to sell it. So the question is, their quality is very low because they are low PPE, very bad PPE, They do not have any technology, they are not using any unique technology. And so the question will be like, why should we buy goods from super goods and not from the competitors? Because they are not giving any new technology, so why should we buy it from you? So so if you look at here in point number 1, there is something they are mentioning about property, plant and equipment, is that the property includes a property acquired by super goods some years ago, which means it's relatively newer and this was revalued. But what this kind of property is, how will that will help entity generate business and profits is not mentioned, so that more information is required on that fact, and this needs to be further investigated. So the company has recently purchased a PPE and have been revalued recently. However, there is no further information about how this property is going to help entity generate business and profits. This may have to be investigated further. So these are the issues, and finally we have also mentioned about the positions, and the last topic that we need to mention is about the conclusion. So we have talked about the performance, we have talked about the financial position. So what is the conclusion? It's very much simple to explain the conclusion, because they are both suffering from both the performance as well as the position, and further information as requested could give us more insights onto their issues and help us resolve immediate concerns. The financial performance seems to be better than the position aspect, because even though it's not better compared to the industry average, but they are generating profits, which itself is a good sign, and the profits they are generating is also a good number. Like from 120,000 they are generating 8,200. So if you look at the net profit is around 8,200 divided by 120,000, which is around 6%, which is seems to be okay. But definitely further, and with the they are also giving dividends, huge dividends payments, so their performance seems to be okay. But how they have been managed, like the entity is not poorly managed very well. They could have been managed better. They could have given more importance to aspects like gearing. They could have given importance to like revenue collections, receivable collections from their investors. Immediately lease out certain property, plant and equipment that generates better efficiency, so the inventory turnover period is very less and better quality can also be used, etc. So you can say overall the entity's performance on both entity's performance and position seems to be not very good, and they are not very good. You can mention that. However, more information as requested above could help us in analyzing further details and resolve any immediate issues. Further, the entity's performance seems to be better compared to their financial position. If they are not being addressed soon, then the entity can end up being under serious trouble of liquidity and cash flow issues. is the answer that we need to write, and this is the conclusion that we need to write. See, I'm used a lot of answers that's given by the ACCA itself, and I have used my own experience. So you might not be able to give up to that mark which is suggested answers, or in fact a tutor can give while he's explaining, because I would have taken my own leisure time to prepare these answers, etc. But when you are in the exam, it's all about how well you comment, and one of the aspects that will help you to better your commentary is this: what, why and how. What is the issue? Why do you think there is an issue, and how can you resolve it? How can you make it better? So if you look at here, every sentences we are trying to say that further improve the prices, or further improve their position in terms of doing this, doing that, etc. Those kind of resolution answers should be given, so that the examiner can understand that, okay, you know what, you have looked at the analysis and you are also able to give reasonable solutions which will help the entity. So it will give them an indication that you are ready for the next level.